All right, everyone, and welcome to our webinar on understanding 1031 exchanges, which is a topic that I know is used daily almost in our office or is reviewed daily in our office at Strongbrook, and is one that, a lot of people get confused about. There's details to be clear about, and there's a lot that we're going to go in to discuss that and how it plays into your overall real estate strategy, how it plays into investment, and all the things that you need to consider. And just for a minute before we do that, just a quick update as always. If you're looking for these replays, all of the replays are always posted right on the same page. So you actually have access to all of our previous market updates up to this point, as well as our previous PSA Academy, and we're going to talk about the upcoming one in just a second here. But if you want to get access to any of those replays, that replay link is right on the screen. It's strongbrookglobal.com/PSA-market-updates. So you can get all of the calls, and then this replay from tonight's call will be posted there, and you can get access to that right away. And then if you have any questions about this call, or if you have any direct questions about your game plan and anything that comes from this, you'll want to go through one of our property review or property analysis processes. So again, we can look at the properties you already have or the properties you're looking at. We can look at different markets and solutions and conditions for you. We can help you know when to sell or refinance for the most benefit if you've got property already. And then for a lot of you, it's just about how do we get your game plan moving faster. So this will be posted right on the replay page as well, but for those of you who know you need to get into a chat with a project manager, strongbrookglobal.com/review. So you can always get that. And again, we'll talk about that a bit more as the call goes on, but any questions, any review, any deals you're thinking about, whatever's going on that's pushing your game plan forward, again, don't do it alone. Talk to our team, strongbrookglobal.com/review. And then finally, I mentioned PSA Academy earlier. It's free to all PSA holders, so if you are eligible to be on this call, you're eligible to come to the Academy. And really, it is our growing community of real estate investors. So our team is joining us. We actually have our team from the Memphis market coming in to join us. And for a lot of you, it's just how do you touch base when you're not investing right now or you're preparing for your next investment. And if you haven't registered for that, make sure you do strongbrookglobal.com/academy to get that all set up. And so without further ado, I want to get into tonight's call, and I'm going to bring on Tyler Bennett. Tyler, again, leads our real estate fulfillment side at Strongbrook, and, of course, has done many, many investments himself, and he's going to be introing the topic and introing our speaker for tonight. So, Tyler, are you out there?
I'm here. Thanks, Ken. Good to be with you tonight, everybody. I'm excited to do the 1031 exchange call tonight. You may have seen in some emails we sent out, but a lot of our clients have been asking for additional information about 1031s and how do they work and how do I use them to my benefit and what's the power behind deferring some of my gains and having 100% of my gain to work with as opposed to paying taxes and having 85% or less of that gain to go work with, and it's a very powerful tool that you can use, especially exponentially as you forecast out 5, 10, 20 years down the road of 1031 exchanges and how powerful it can be. So I'm excited for this topic and for the guest that we have with us, and I'm going to introduce you to him, and he's going to take about the first 20 to 30 minutes of this call to really go through and introduce us to his company. They're a qualified intermediary, and you have to use one of these types of companies in order to do a 1031 exchange the right way. And a little bit about him. His name is Mark Bullock, and he's with a company called First American Exchange Company. And many of you know we use First American Title for many of our real estate transactions and closings. In fact, with one of their particular escrow agents, we've closed over 1,000 transactions with Strongbrook clients. And so they're a national company. They're a big corporation. They've got a great and strong brand and reputation, and so they're really our preferred vendor for 1031 exchanges. And a little bit about Mark. He's an attorney, has been an attorney for over 15 years, and he worked for 5 years with a law firm, and then he's been with First American Exchange for 11 years now. And in talking to him before this call, I asked him a few questions just about the number of transactions, and frankly, I was surprised at the volume of transactions that Mark and his office has been responsible for since his time there. But he's done over 15,000 exchanges, and his single largest exchange was a $1.5 billion 1031 exchange for one single client. And you know, if you do the math, if he's done 15,000 exchanges and one of them's been over $1 billion, you know, he's really done billions of dollars worth of exchanges. And when you add up the tax savings that all of those individual clients have had through those exchanges, it represents a very significant amount of money that's in the economy, that's creating wealth for them, as opposed to being paid to the government in capital gains taxes. And so without further ado, I'm going to bring on Mark and have him go through his presentation. And when he's done, we'll open it up for some questions, and then I'll jump back on, and I want to go over a couple examples, some specific examples of some recent Strongbrook clients that have used 1031 exchanges, used Mark's company, and walk you through an actual example of what they bought the house for, what they owed on it, when they sold it, how much they sold it for, what they did, and just walk you through that entire transaction. And then if we have time, I have a personal example of a 1031 exchange that I'm going through right now, and I'll share that example and what those numbers look like. So Mark, you there?
I'm here, thanks. Thanks for the introduction.
Great. Yep, you're welcome. It's all you.
All right, we'll just move right into it then. So appreciate the introduction. Again, Mark Bullock with First American Exchange. You know, 1031 exchanges can be very complicated, and here we have a pretty complicated definition of 1031 exchanges, but to be simplified, a 1031 exchange is really just a transaction where a real estate investor can avoid capital gains taxes by swapping business or investment property, business or investment real estate for another piece of business or investment real estate. And through that process, if you do it correctly, you can avoid paying capital gains taxes. So here's the definition here, but to be simplified, just to swap a business or investment real estate for business or investment real estate. Okay, so in our industry, QI is short for Qualified Intermediary. So what's a QI? First American Exchange Company, we are a QI. You've got other QIs throughout the country. You don't need to worry about those other QIs. Just focus on First American Exchange Company. We are a national qualified intermediary. We've got offices throughout the country. We're wholly owned by First American Title, which is a deep pocket. First American Title supports our transactions, guarantees our transactions so that you can be secure that you know that your funds are safe through the 1031 exchange process. Here are some websites for our company. The most important website is the one on the top, www.firstexchange.com. Really, that website has all the information on our company, all of our offices. There's a wealth of information in terms of 1031 exchange topics. So, you know, visit that website. Let me know if you have any questions. It's a great website. So what is a QI? The QI in a 1031 transaction, you know, when you sell property in a 1031 exchange, the seller of that property doesn't actually receive the funds. The funds go directly to the QI. And so the QI that you hire is the party that prepares the 1031 documentation and also holds the money from the sale until you're ready to use that money towards the next property in your exchange. So when you close a 1031 and it's your money that's being held by another party, you want to make sure that the QI that you select is someone that you trust, someone that has, you know, financial backing, so that you know, you're not going to be in a situation where the QI that you select goes bankrupt or has a problem or has someone that steals money, and then you end up losing your money. Back in the 2008-2009 time frame, you know, we had a lot of qualified intermediaries go bankrupt. You know, the real estate market wasn't good, and so what happens in bad real estate markets is that a lot of real estate players go out of the industry and go bankrupt. And so we had a lot of competitors, you know, during that time frame that went bankrupt. And when you have a QI that goes bankrupt and they're holding 1031 money, the question becomes, well, whose money is that? Is it the QI's money that then goes into the bankruptcy estate, or is it actually the client's money and, they get that money back? And so, fortunately, the bankruptcy courts were, they ruled in favor of the 1031 clients, so that, for the most part, 1031 clients were getting their money back. But the problem is that it took a super long time for the bankruptcy judges to get to that point. And, really when a QI files bankruptcy, you're going to lose, if you're a 1031 client, you're going to lose some of your money. And so those clients that did get their money back, they got their money back at pennies on the dollar. So you want to be careful of who you select in terms of who your QI is going to be on a 1031 exchange. And so when you select a QI, security of funds is probably your number one thing. You got to look at knowledge and experience, and you got to look to see that the QI is qualified per the regulations. So, there actually are no federal regulations for QIs, and so, you don't have like a list of endorsed QIs from the federal government. So when you call and select a QI, it doesn't necessarily mean that that QI has been endorsed by the federal government. Some states actually do have regulations, but the list of states that have regulations is very small. Of course, First American Exchange is licensed in all those states where licensing requirements are required, but here in Utah and a lot of the states throughout the country, there just aren't any licensing requirements. And so again, you don't really have a list of endorsed companies by the state or by the federal government. So you got to look to make sure that the QI that you select is, has been around, has financial backing, etc. So look to the financial strength of the QI. Is the QI owned by one or two people, or is the QI owned by a large company that's been around for a really long time, that has deep pockets, etc.? So First American Exchange is wholly owned by First American Title. We're a national 1031 accommodator. First American Title is a national provider of title and escrow services. We have billions of dollars of assets, and so we have the financial backing to protect your client's money. Okay, so here's some more information on our company. Another thing that we do at First American is, again, our transactions are guaranteed by First American Title, and when we open a 1031 exchange, First American Title signs an indemnification letter in favor of the 1031 client to protect that client from any loss of funds. Another thing that you want to look at when you choose a QI is whether the QI has a fidelity bond and E&O coverage. What is a fidelity bond? Well, a fidelity bond is just insurance for fraudulent acts. So if I hire someone here at First American, if I hire someone that ends up being a bad employee, and that employee steals money, steals one of our clients' money, we have insurance for that, and our fidelity bond is $20 million. What is errors E&O insurance? E&O insurance is basically insurance for not for fraudulent acts, but for negligent acts. So if I have an employee that doesn't necessarily steal money, but they just they made a mistake, and as a result of that mistake, they wired your client's money or your guys' money to the wrong account, and as a result of that mistake, you lost your money. We have insurance for that as well, and that's $5 million. So another thing you want to look at when you choose a QI is whether the people that you call at the QI office actually have experience doing exchanges. A lot of times you can call a QI and you can get a really low fee and a really low cost 1031 exchange, but the people that you call to ask questions and set up your exchange really just don't know anything about 1031 exchanges, and sometimes these exchanges can get pretty complicated, and so you want to be able to call someone that can answer your questions. So here at First American Exchange, I'm an attorney, and I have a staff of 4 assistants that work with me, and they have literally helped me with thousands of exchanges. Okay, so what are capital gains? When you buy something, whether it's a baseball card, a piece of real estate, a piece of artwork, if you end up selling that item for more than what you purchased it for, it's a capital gain, and the IRS wants you to pay taxes on the capital gain. We're going to focus on real estate, so just from a very basic example, if you buy a property for $100,000 and you end up selling it for $200,000, the difference is $100,000, and that's going to be your capital gain. So what do you pay, assuming that you do have a capital gain on the sale of your real estate, what are you going to pay in terms of taxes if you don't do a 1031 exchange? And so the first round of taxes that you would pay are federal capital gains taxes. And basically, if you've owned the property for at least a year and a day, you're going to pay long-term federal capital gains rates on your taxes. And right now it's 15% for most people. If you make more than $400,000 as an individual or $450,000 as a married couple, then that 15% rate bumps up to 20%. And then on top of that, if you live in a state where there's state income tax, such as Utah, Utah's 5%. Some states don't have a state income tax, but typically most states do, and it typically ranges anywhere from 5 to 10%. So if you sell a property and you don't do a 1031 exchange, you're going to be paying state taxes. Again, Utah's 5%. I heard some of you are in California. It's much higher than 5% in California. And then on top of that, if you sell property and you don't do a 1031, and the property was a property with a structure on it that you depreciated, then the IRS wants a recapture of that depreciation at 25 cents on every dollar that you depreciated that property. And then sort of a hidden tax, when you sell real property, if you're a person that makes more than $200,000 as an individual or $250,000 as a married couple, then you're also subject to a 3.8% tax that's sort of hidden into that profit on the sale of your property. So taxes can be significant if you don't do a 1031 exchange. And again, all of these taxes are taxes that are deferred through the 1031 exchange. So if you do a 1031 and you do it correctly, then you won't have to pay any of these taxes. Okay, so what is boot? Just because you do a 1031 exchange doesn't mean that you're not paying taxes. If you have boot in your transaction or any financial benefit that you receive through the exchange, it's boot and you're paying taxes on any boot. So if you do a 1031 exchange and you have boot, you're going to pay taxes on the boot. So let's talk about how we can avoid having boot in our 1031 exchange transaction. So if you do a 1031 and you want to avoid paying all the taxes, just look at two general rules. The first general rule is you want to reinvest all of the proceeds from the sale of your property into the next property, which is called the replacement property. So reinvest all the proceeds from your sale into the purchase property. And then the second rule is that you want to replace the debt from your old property into the new property with equal or greater debt in that new property. You can also replace the debt from your old property with new cash. So let me say that again. So you want to reinvest all the proceeds from your sale into the new property, and then you want to replace your old debt with either new debt or new cash into that new property. If you trade down in proceeds or if you trade down in debt, then you've got boot and you'll pay taxes on that boot. Okay, so let's look at some examples here. So on the left-hand side, you have the relinquished property, which is the property that you're selling in exchange, and on the right-hand side, you have replacement property, which is the property that you're purchasing. So in this particular transaction, client sold a property for $300,000, a loan of $100,000, and equity of $200,000. On the right-hand side, they went over and they bought a property for $400,000. They went out and got a loan of $200,000, and they replaced their equity of $200,000 into that new property. So in this particular transaction, there's no boot because they traded up in value, they replaced their loan, and they also replaced their equity or sales proceeds. Here's another example. 1031 client is selling property for $300,000. They bought a new property for $300,000. They had a loan on their old property of $100,000, and they went out on the new property and got a loan of $150,000. They had $200,000 equity in the old property. New property, they only used $150,000 of that equity in the new property. So do we have boot here? And the answer is yes, we have boot. The client here they had $200,000 of equity, and instead of using all of that equity towards the new property, they kept $50,000 of it and put it into their own pocket, and went out and got a loan that was just too much for this property. They could have avoided boot in this situation if they just got a loan for $100,000 and then used all their equity of $200 into that new property. So where we see this in these types of transactions is, you have a client that wants to do a 1031, and when they're getting ready to sell their relinquished property, they'll say, look, we want to do a 1031 exchange, but when we sell our relinquished property, we don't want all of the $200,000 of equity to come into the exchange. We want to just keep $50,000 of it, and have the title company that's closing that relinquished property just send us $50,000 from the sale, and we'll just have 150 of it go to the 1031 company. So they receive the $50,000 before the 1031 even starts. That's a boot. They have to pay taxes on that. The other way that we see it is, in a situation where the 1031 client allows the full $200,000 of equity come to the 1031 exchange company, but when they go to purchase their replacement property, they just overshoot on their loan by $50,000. And so really all they needed was a $100,000 loan here, but they went out and got a loan for $150,000. And so when it came time to close on the replacement property, and they asked the 1031 company to send the money from the 1031 to close the replacement property, all we could really send is $150,000 because that's what was needed to close the property, leaving $50,000 in the exchange account. And then when the exchange expires, we just have to send that $50,000 back to the client, and that's boots the client, and they've got to pay taxes on it. So $50,000 of boot here, they could solve it by buying a second piece of property in this particular exchange and using the $50,000 on the second piece of property. Again, otherwise they would have to just pay taxes on that boot. Another example, selling for $300,000, buying for $200,000. In this example, the client had $200,000 of proceeds from their sale. They used all those proceeds on the purchase, but because they traded down in value, they didn't necessarily need to go out and get a loan to replace that old loan. So we see this a lot because we have clients that they have property, they have investment property that they want to sell, they want to do a 1031, and of course they don't want to pay any taxes, but they also want to just get out of debt. And so they'll come into the program and they'll think, look, I'm just going to do a 1031 and I'm just going to replace the proceeds from my sale into the new property, and I'm not going to replace the loan from my old property into the new property. And so this is a really good way to get out of debt, right? Well, the problem is that the IRS wants you to, through the 1031 program, they want you to reinvest into the real estate market at the same level that you sold at. And so here, by trading down in value by $100,000, the client's got $100,000 of boot. It's technically called mortgage boot because they didn't replace their mortgage. The client could solve this problem by going out and buying a second piece of property for $100,000 and either paying for that second piece of property with cash, $100,000 of cash, or just getting a $100,000 mortgage. If they don't buy a second piece of property, then they'll have to pay taxes on the $100,000. Okay, so you guys probably all know that when you do a 1031 exchange, you've got to swap real estate for real estate, and the real estate requirement is very broad. You can swap residential for commercial, commercial for raw ground. It's very broad, but the other element to like kind on a 1031 exchange is the property that you sell and the property that you purchase. They both have to be properties that are held for business or investment purposes. So what is a property that's not like kind? So like I said, it's got to be real estate for real estate and business or investment property for business or investment property. So the one property is sort of a black and white, absolutely does not qualify as a primary residence. So if you're selling a property and it's your current primary residence, like the one here on the top left-hand corner, it's a great house, but if it's your current primary residence, it doesn't qualify for a 1031. If you're buying a property on a 1031, so let's say you you sell a property on a 1031 that qualifies, like a duplex or a rental property. When you go to buy a property on a 1031, again, if it's going to be your current primary residence, doesn't qualify for a 1031 exchange. Stocks and bonds don't qualify. Mortgage notes do not qualify. So sometimes you'll have a client that will sell a property on a seller carryback situation, and they'll sell their property and they'll take a promissory note back where the buyer's paying them over time with like a lump sum that's due, like a balloon payment at the end of the note, and they'll call us and they'll say, look, I'm getting paid a lump sum balloon payment on a promissory note, a seller carryback promissory note. Can I do a 1031 exchange on the sale of, on that lump sum balloon payment? And of course, the answer is no, you cannot do a 1031 exchange on the sale of a note. A partnership interest is an interesting situation. Sometimes when you sell property in a 1031 exchange, sometimes you hold the property in an LLC with a co-owner, a partner, etc. So if you own a property in an LLC, the LLC that owns the property can do an exchange because the LLC owns the property and can swap on a 1031 exchange. But the actual members of that LLC, if those members want to go separate ways, one wants to take cash, the other wants to do a 1031, or they both want to do 1031s, but they just want to go into separate properties, then you have a problem because what those individual members own is not a real property interest that you can swap on a 1031. They own partnership interests in an LLC, and so those aren't items that you can swap on a 1031. To solve that situation, the members of an LLC would just have the LLC deed the property out of the LLC and put it into the members' names as tenants in common, and then those members as tenants in common could do 1031 exchanges with their interests. Personal property, you can't swap real property for personal property, but you can do 1031 exchanges on personal property as long as you're swapping personal property for personal property. And with personal property, the like-kind requirement is much tighter. You can't, if you're selling a ship, you've got to swap it for a ship. If you're selling an automobile, it's got to be for a specific type of automobile. So like-kind requirements are much tighter. Dealer property. So if you're a home builder, or if you're Donald Trump, and what you do is you buy property in large chunks, and then you develop it, and then you sell it off in small chunks, the IRS is going to see you as a dealer, and the IRS doesn't want dealers to do 1031 exchanges. They want dealers of real property like home builders and condo developers. They want those types of real estate developers to pay taxes on the sale of their individual units. So that type of property doesn't qualify on a 1031. What about goodwill? What if you're selling a property like a Subway or some sort of a property where the actual name of the business has value in and of itself, and part of your sale is real estate, but part of your sale is the value of the business, the name of the business. Well, in a 1031, if you're selling a business, you can absolutely do a 1031 exchange on the real estate assets, but the IRS is not going to consider the goodwill of the name of the company, the value of the company, to be something that you can swap on a 1031. Inventory is very related to dealer property. It's just property like a home builder where they've developed a big chunk of land and now they're selling off pieces of that as individual single-family residences. All of those individual single-family residences are going to be considered inventory of the dealer or the home builder, and those are items that the IRS don't want to see on 1031 exchanges. Okay, so we alluded to this a little bit. For real estate exchanges, the like-kind requirement is very broad. You can swap a single family for raw ground. You can swap industrial for retail, a barn for office space. Very broad. One thing that you can't do is you cannot go out of the United States on a 1031 exchange. So I do get calls from clients that they've entered the 1031 program where they've sold something here in the U.S. and then they go on vacation and they call me from France or Italy or wherever it is that they've gone on vacation, and they'll say, look, Mark, I'm here in France, can I use my 1031 money to buy a little chateau or a villa? And of course, the IRS wants to keep that potential taxable money here in the United States, and so you can't swap the Washington Monument for the Eiffel Tower. It's got to be U.S. property for U.S. property, which also includes any U.S. territory except for Puerto Rico. Okay, so on a 1031 exchange, you can consolidate by selling multiple properties and going into one larger property. You can also diversify by going, selling one large property and going into, 3 or more smaller properties. So it doesn't have to be one for one. It can be one for multiple or multiple for one. When you do a 1031 exchange, when you sell your property and the funds from the sale come to the QI, you get 45 days to formally identify property that you would like to consider buying in your exchange, and 180 days to close on any of those properties that have been identified in the exchange. The 45-day identification period is a huge issue in this industry. In this market where it's hard to, it's really a seller's market, it's really hard to lock up a property on a 1031 exchange. And so, that 45-day period is a very short period, and so that's the biggest complaint that we get on these 1031 exchanges. And so, if you're in a situation where you're going to sell a property and it's going to be a 1031 exchange, then what I would recommend is as soon as you get that property under contract, typically you have 30 to 60 days where the buyer has to, a 30 to 60 day escrow where the buyer has to close on that property. Use that 30 or 60 days of escrow to be out looking for property. You can be out signing contracts on property so that when your property sells and your 1031 clock starts ticking, you know exactly what it is that you can identify during this 45-day period. If you wait until the 45 days starts ticking, it's going to be very difficult for you to lock down the property or the property that you want to put on your list. Okay, so day 0 is when you close. Day 1 is the next day after closing. We typically on day 1 will send you guys, if you enter the 1031 program, we'll send you a welcome package with an identification form, a statement of account. You can use the identification form to identify property. Again, you get 45 days to identify, and that's a hard and fast rule. You cannot call the 1031 company and say, look, none of the properties on my list worked out. Can I switch out the identification form with other properties? You can do that at any time prior to the expiration of the 45-day period, but after day 45, the identification form is sort of locked in and can't make any changes. Again, 180 days to close. Okay, so the identification rules, how do those work? So one of your options when you set up a 1031 exchange, one of your options is to identify 3 properties. So we'll send you a form. You can identify up to 3 properties. Of course, on a 1031 exchange, you want to trade for equal or greater value. So you want to keep that in mind when you identify property. But if you stick with the 3 property rule, you can identify 3 properties, and it really doesn't matter how much those properties are worth. If you go above 3 properties, so you want to identify 4 or more properties in your 1031 exchange, then you have to be aware of the total value of all those properties on your list. You have to add up the value of all the properties on your list and make sure that the total value of all those properties on your list is not more than 200% of the value of the property that you sold in your exchange. So if you sell a property for $1 million and you choose to identify 4 properties or more, you've got to add up all those properties and make sure the total value of all those properties is not more than $2 million, which is 200% of $1 million, which is what you sold the property for. If the value of those properties exceeds 200%, then your exchange fails. Right. So if you violate the 200% rule, then your exchange fails. Okay, so identification, you have until midnight on the 45th day. Again, we provide you with the form. You just basically have to sign it, fill in the addresses, and then scan and email it to our company, and we will keep it here on file. In the event that the IRS performs an audit, we'll have it on file. We'll have the date that you submitted it and the properties that you listed. Again, so at any time prior to the 45th day on your identification period, you can change your identification. You can switch out properties, etc. It just has to be done before that 45 days is up. Okay, so if you're thinking about doing a 1031 exchange, the first thing that you want to do is be out looking for a QI. Kind of feel like First American Exchange is a strong option for you. Give us a call. We can answer any questions that you might have on your 1031 exchange. So that would be the first step, is to reach out to us, get a sense as to who you want to work with, and then put your property under contract, or excuse me, list your property, and then when you put your property under contract, make sure that your contract has 1031 cooperation language included in that contract. The cooperation language is very boilerplate, and most realtors are going to have access to that type of language for your contract. If you don't have that language, just reach out to us and I'll provide you with some sample language that you can put in your contract. And then once you've decided on who you're going to use in terms of a title and escrow company, you go ahead and submit your contract to the title and escrow company. Reach out to us and let us know who it is that you're working with in terms of title and escrow, and then we will prepare and submit the requisite 1031 documents for the closing. Once that closing takes place, the funds from the sale will come to us, and we will hold those funds on your behalf until you're ready to use them in your 1031 exchange. Again, 45 days to identify, 180 days to close. We will work with you through the identification process. We'll provide you with the form. And then you'll be out looking for a new property, and when you get a new property under contract, one that you want to purchase, again, you'll want to include 1031 cooperation language in that contract. We can provide that language for you, and then reach out to us and let us know who it is that you're working with in terms of the title and escrow, and we will submit the requisite 1031 documents to that title and escrow company so that when it's time to close, we're in a position to send your 1031 money to that title and escrow company for the closing. Okay, so this is really just a summary. 45 days to identify, 180 days to close. In order to avoid boot, in order to avoid paying taxes on your exchange, you want to purchase a new property that's of equal or greater value. You want to reinvest all your cash equity from the sale property into that new purchase property. You want to replace the debt from your old property with equal or greater debt on the new property, or with new cash. Do your research when selecting a QI. There's a lot of good QIs out there, but there are also a lot of QIs that have just, they've seen how the market is good, the real estate market is good, and so they're new to the game. They don't have the financial backing. I would be wary of those companies, because when the market goes down, those companies will be leaving the market, and if they're holding your money, then you could potentially lose your money through that process. So I think that concludes what we have here. Are there any questions? I don't know if there is a question process through this, but I do appreciate the opportunity, Strongbrook. Let me know if anyone has any questions, either through this webinar or you can call me at any time.
Okay. Mark, thanks. That's great information. I do have a couple questions that have come in while you've been talking. One of the questions asked multiple times is, how does the fee structure work, and with First American Exchange, or just 1031 exchanges in general, and then can those fees be counted in the exchange formula?
Right, very good question. So when you sell your property on a 1031 exchange, the IRS allows you to deduct the closing costs from the sale. And so let's assume you sell for $100,000. You've got a real estate commission, title and escrow fees, 1031 fees, anything that would be a standard closing cost on the sale of property are items that you can deduct from the sales price. And then once you've deducted those items, that new number is the number that you need to focus on in terms of replacement on your 1031 exchange. So you don't necessarily have to replace the full value of your sales price. You have to replace the full value less your closing costs, and your 1031 fee is going to be something that is going to be included in your closing costs. In terms of the fee structure, you know, we have a tiered fee schedule, and generally for anything up to $500,000. So if you're selling a property for $500,000 or less, we charge a flat fee of $695, and the $695 covers one sale and one purchase. And then anything from $500,000 up to $2 million is $895. And again, that's one sale and one purchase. And then typically anything above $2 million is $1095. One sale and one purchase. Our company is a national company, but we do have, you know, we do have several offices that have different fee schedules. And so if you call First American in Southern California or in Chicago, New York, or Utah, you're going to get different fee schedules. And so those are just my fee schedules out of my office.
Okay, cool. That makes sense. Thanks, Mark. Let's see. I'm just reading some questions here. Okay, somebody asked a question, and this is actually a really great question. They said that they have a property that they're going to be selling, and they want to do a 1031 exchange to buy several properties with the profits, which is perfect. We do that all the time for our clients, and in fact, the example I have that I'll go through in just a minute shows one of our clients that purchased in Phoenix in 2011. They sold at the end of 2015 and then bought one house in Florida, one house in Indiana through our system. So they do that all the time. And the question is, do I have to purchase the new properties in the same business entity or LLC? So this brings up one of the points that I'll answer, and Mark, correct me if I'm wrong. But what you're going to want to do, if many Strongbrook clients purchase a house in the name of the individual, because that's how they acquire the conventional financing. So I'll just use me as an example. I buy it in Tyler Bennett's name. After I close, I may elect to put it into Tyler Bennett Real Estate LLC from a liability protection standpoint. If I were to sell the house in Tyler Bennett LLC, then I would be, and I did a 1031 exchange, I would be required to purchase in Tyler Bennett LLC because that's the name that the exchange is done in. So if I'm able to purchase in Tyler Bennett LLC, then that works. If I'm planning on getting conventional financing, what you'd want to do is, prior to closing, is to transfer title back into Tyler Bennett individual, make the sell, do the 1031 in Tyler Bennett, purchase 2 more properties and get conventional financing in Tyler Bennett, and then put the properties into the LLC after the fact. So hopefully that makes sense. Mark, do you follow that? Is that accurate?
Yeah. And so, so the general rule is that the way that you sell a property on a 1031 is the way that you need to purchase your new property. So if you sell as an individual, you have to buy as an individual. If you sell as a trust, you have to buy the same trust, LLC, corporation. And so that's the general rule. There are 2 notable exceptions. One is where if you're dealing with a single-member LLC, a single-member LLC is a disregarded entity for tax purposes, and so the IRS will look through that single-member LLC, and it's as if the sole member for financing purposes. And again, really where we have the problem is where we have properties where they're held by multiple people in an LLC or a corporation or something like that. That's where we have problems, and those people want to go separate ways. But if you own a property in an LLC or in a revocable trust, and you need to go out and buy a new property, and you need to get financing, of course, the lender is not going to loan to an LLC or a trust. They're going to loan to an individual. And so as long as you're dealing with a single-member LLC on the sales side or a grantor revocable trust on the sales side, then it's okay to go into the next property as an individual and get that financing. And then after you close on the property, then you can put the property back into a a single member LLC or back into your grantor revocable trust, and that's fine for the 1031 exchange.
Okay, cool. Thanks, Mark. That makes sense. Let me see if there's any other questions. I think that's all the questions that I have coming in right now. So with that, I want to thank Mark. Hopefully you found that to be very useful information. As you can tell, Mark's definitely an expert in this area, and he was kind enough to adjust a 2-hour presentation down to 30 to 35 minutes for our webinar today, and appreciate him taking the time to do that. So with that, Mark, we appreciate you being on, and look forward to referring you guys a lot of business as our Strongbrook clients continue to sell properties and buy more properties. So I'm going to jump into just a quick example of a recent Strongbrook client that we have that went through this process, just so you can kind of see some numbers behind it, and many of you that own properties are in a similar situation. The example I want to use, the client, our client purchased in November of 2011 for $117,000. And you can see my just notes here. I think best if I have a blank whiteboard or white piece of paper as I write these out. So that's the process I went through, and you can look at it right here. And they did a down payment of $30,000 and got an original loan of about $87,000. They sold this property in October of last year for $175,000, and the loan balance at the time of the sale was $78,704. And they sent $77,524 to the 1031 exchange company. They used First American Exchange and Mark's office. And within the 45 days, the beginning of December, they identified 3 different properties, 2 in Indiana, 1 in Florida. And of course, one of the benefits of our system is we can help you identify and take a lot of the stress and pressure of this 45-day identification period away from you. And in fact, we've got a couple clients right now that are selling pretty significant commercial properties, and they'll be purchasing anywhere between 10 to 20 properties through a 1031 exchange. And if you can imagine going from the sale of 1 property to purchasing 15 or 18 properties and having to identify all of those in a short amount of time, that's a pretty stressful process. And so, of course, we've got line of sight to these. We know when they go under contract, and we can start helping identify and reserving these properties ahead of time. So when they do close and that 45-day clock starts ticking, we're ready to support them. So back to this example. They identified those 2 in Indianapolis, 1 in Florida. They ended up closing on 1 in Florida and 1 in Indianapolis for $130,000 and $100,000. You can see the 1031 exchange money was separated into 2, and the client can elect how much of it goes towards which one. And then you can see the loan amount that they got. And so a couple things that you just look at is the total value. They went from $175,000 sales price to $230,000 in purchases. So they met the requirement as far as that goes. The equity or the debt that they needed to replace went up. And so they met, they owed $78,000 at time of sale. The new loans that they got was $173,000. And so that worked. So this was an effective or efficient way of doing a 1031 exchange. The next example I have is one that I'm going through right now, a house I just put under contract, and I've been in touch with my CPA. And that's one other thing that I just wanted to point out. Mark is an expert at 1031 exchanges and the qualified intermediary role and their company, and that's the role that they play. But they're not necessarily tax advisors or CPAs or the IRS, and they don't necessarily determine if it's a qualified exchange. They simply take the amount of money that you request that they take, and then they send it where you ask them to send it. Now, they are smart enough business to spend time on teaching their customers how to do a qualified exchange and an appropriate exchange, but they don't necessarily determine or underwrite each exchange that they do to ensure that it's qualified. I have an example of one I did earlier in 2006 that I did incorrectly. And at the end of the year when I did my taxes with my CPA, my tax bill was higher than I expected because a portion of my 1031 exchange monies I had to recapture and recognize as a capital gain because I did it incorrectly. But the example I have right now is a home I'm selling. I purchased in 2005 for $232, and I'm selling for about $280,000 right now. I've got about $10,000 in closing costs, so my net sales price is about $270,000. My loan balance today is $190, and the actual cash I'll get at close is about $80,000. Now, Mark mentioned depreciation through his presentation, and that comes into play on this home because I've actually depreciated this house down to $196,000. So it's important not to look at the difference between $232 and $270 as my taxable gain, because my basis isn't $232. I've taken a benefit in taxes each year, and so my basis, my capital gain, is really the $270 minus the $196, which is $74,000. So that's the gain that I want to defer if I possibly can. And if I were to pay 20% in capital gains, 3.8% in Obama tax, and all these different things, it could cost me, you know, over $20,000 in taxes, and I would have a lot less to work with. And one thing I wanted to do or look at doing was buying a condo down in St. George, which is in southern Utah, and something that I could rent out and use a couple times a year. That was $210,000. I could put down the 74 from my 1031 exchange and get a new loan for 136. However, it wouldn't work, right? Because I need to replace the value. The value is that 280 or 270, as Mark explained technically, after closing costs, and a 210 purchase wouldn't do that for me. And I need to have a minimum amount of equity or debt on that home that's equal to what I'm coming out of, and that loan amount would be too low. And so if I went and did that, technically the qualified intermediary would do the transaction. They would take the 74 grand and they would send out the 74 grand. But of course, the IRS and my CPA would catch that a big chunk of that, if not all of it, isn't qualified, and I would be responsible for the capital gains on it. So just a couple other tips to point out. I talked about the LLCs, moving out of the LLC prior to the sale of the property, and then purchasing, and then getting back into the LLC, and then giving the title company notice, giving Strongbrook notice that you want to do it, because 1031 language needs to be in the contract, like Mark mentioned, in the sale and the purchase. Oftentimes, somebody gets 5 days out from closing, and all of a sudden they notify us that they're interested in doing a 1031 exchange, and then everybody has to scramble. It can push out the closing because the buyers need to notify their lender and send in addendums and all these different things, and it puts more stress on that 45-day period. So the more notice you can give us, the better. And then lastly is just a reminder that to consult CPAs in advance, and as you look to sell properties and go through your property analysis with your property managers at Strongbrook, look at what those gains look like. Be aware of depreciation if you have depreciated over time, and what your true capital gain is, so that we can advise and make recommendations with as much information as possible. So that's all we have for you. We like to keep these calls under an hour, and we're approaching an hour, so I'll finish up there. But hopefully, again, this information has been valuable and useful and helps you as you plan your game plans and make your next steps to build your real estate portfolios. And we're happy to assist however we can. We've said it before, and you'll keep hearing it from us. We recommend these property analyses. The market's up right now in many of the markets that our clients have purchased in, and it can be a great time to sell. And the more educated you are, and the more you understand how 1031s work and what your options are after you sell, the more comfortable you'll be with making a decision whether it's the right time for you to sell or not. So we'd encourage you to go through that process. So appreciate your time tonight, and look forward to getting feedback on how this webinar was, and continue to submit information on additional topics that you'd like to hear us talk about, so that we can teach you what you want to learn and get that information out. So with that, Ken, I'll turn it over to you to wrap up.
And one thing before you drop off I wanted to ask is, you mentioned the property review. I would just like for you to talk for a moment. We have PSA Academy coming up in just a couple weeks now, and a lot of you out there are not local, but for those of you that want to make the decision to come to PSA Academy, Tyler, you're a big piece of that. You help put all the education together. Why do you think people should come to the Academy?
Well, to build on just tonight's topic, one of the things we'll be going over at PSA Academy is 1031 exchanges and handing out sample worksheets so people can work through them, or if they have actual properties, there'll be an opportunity for us or for them to put their real properties information into these worksheets to see what it would look like to sell their property and how a 1031 would work and what options they have with the proceeds. And so really what it does is it brings your game plan, it brings your real estate to life. There'll be some new content and new education. There'll be some old content because we don't want to drift too far away from the fundamentals of what we do and why we do it. In addition, it's about being around people that are like-minded, doing similar things and creating this community feel so that we can all learn from each other. We can see what other people are doing or how they're doing it, and really foster a great energy from people that think the same and act the same and have similar goals.
Thank you so much, Tyler. And again, for those of you who want to register for either of those things, strongbrookglobal.com/academy will get you registered for the Academy at the end of the month, the 23rd through the 25th. And then strongbrookglobal.com/review. So if you have any other questions, more in-depth stuff, more specific situations, you want to go over that, again, our team is always available to you, so make sure you submit that. And we'll see you on next month's webinar. Thanks, everyone, for being here.